So we're going to work a problem from chapter 16, actually a couple of problems from chapter 16. So chapter 16 talks about standard cost and variances, one of my favorite things to teach, so I'm sad that I'm not doing this in person with you guys, but anyway. So we're going to work first problem, or exercise actually, I think, 1636. Which has our variable cost variances. So, and it refers us back to the information in 1634 and 1635. So this problem is on 692 and so is 635, but you'll have to go back to 691 to get the information you need from 1634. But it said during the year the company purchased 176,000 pounds of material and employed 40,400 hours of direct labor. And like I said, there's some other information you'll need from 1634 and 35. But our basic formula, it asks us here, it's got three parts, A, B, and C. So the first part asks us to compute the direct material price and efficiency variance. The second, part B, asks us to do direct labor price and efficiency variance. And part C asks us to compute the variable overhead price and efficiency variance. So basically they all have the same formula. So we look at, when we look at our variable variances, we have actual cost, then we have actual inputs at standard price, and then we have our flexible budget, which is our standard inputs at our level of production. And so the difference between our actual cost and our actual inputs at standard price, that's going to be our price variance. And the difference between our actual inputs at standard price and our standard input at our level of production, which is basically our standard quantity times our standard price, is going to be our efficiency variance. So, like I said, we're going to use this formula pretty much for all of those. So doing part A, which is our direct materials variance, our actual cost, which I think it gives you
I don't think you can.
It's okay. All right. So I'm having trouble finding where it gives you the, it tells us they used 176,000 pounds of materials, how much they purchased. And I see it says it's in thousands of dollars. Okay, I found it. 1635. It says less variable cost, and it tells you those are all in thousands of dollars. So you see the $748 for materials. That's actually $748,000 because it tells you that it is in thousands. So it just gives you that. You don't have to compute it in this one. And then it asks for our actual inputs at standard price. So it did tell us they purchased 176,000 pounds of materials times our standard price is $4, which it gives us in probably in 1634, which it told us to refer back to. So that is a total of $704,000. thousand. And then here we have what's our standard input allowed. It tells us we produced, somewhere it tells us our production. They produced 94,000 units. So if we produce 94,000 units times 2 pounds per unit times $4 per pound, that should be $752,000 worth of materials. So you can see here we had a price variance. Our actual cost was more than our actual inputs at standard price. So since our actual was more here, our price variance was 44,000, the difference between the 748 and the 704, 44,000 unfavorable. Our efficiency variance $750, so here, this was less than this. So 704,000 minus the 752, if you do it that way, you're with a negative, but this is actually a favorable variance because this one was less. Our actual inputs at the standard price were actually less than our flexible budget. So when we have a favorable variance, this one means we used less than we had anticipated than our standard, but here, we paid a higher price than we anticipated, so we had a unfavorable price variance. Basically the same formula, like I said, for all three of these, it's basically the same formula. So for direct labor, once again, you refer back to 1635, and it gives you that list of variable cost. 1,000, 10 is what it says, but remember you have to add those 3 zeros because everything's in thousands. So our direct labor cost is actually $1,010,000 is our actual cost. Our actual inputs at standard price, it tells us we used 40,400 direct labor hours. Our standard price, it gave us back in 1634, is $24 an hour. And then over here, our flexible budget, so we had 94,000 units produced times the $24 times 0.5 hours is our amount of labor per unit times $24 an hour gives us $1,128,000. So now to get our variances, our price variance, work this one out. This gives us 969,600. So our price variance is going to be the difference between our actual cost and our actual inputs at standard cost. So 1,100,000 minus the 969,600, 40,400. And that, of course, once again, is unfavorable because our actual is more. When we come over here, we have our actual inputs at standard price. We have 158,400 favorable variance because the 969,600 is lower than the 1,128,000. So this means we used less labor than we thought we would, but we paid a higher rate here, is why our price variance is unfavorable. And then part C, our variable overhead. So we have our actual cost for variable overhead, once again referring back to 1635. We have 930,000 Then our actual inputs at standard price, we have our variable overhead is applied based on direct labor hours. So we're gonna use the same direct labor hours we used here. Our overhead rate is $20 per hour for variable overhead, which it gives us also back in 1634. So 20 times the 40,400 gives us 808,000. And then over here, our flexible budget, we have the 94,000 units we produced times 0.5, the same as the labor, since we apply it based on labor hours, times 20. All right. So here we have the 930 minus the 808. So our price variance for variable overhead, 122,000 unfavorable. And here, 130 to the 808, lower than the, I didn't mark this out again, 940,000 here. We're gonna have a favorable variance of 132,000. And anytime your overhead is applied based on labor hours, your efficiency variances are gonna go in the same direction. So since this one was favorable, we knew this one was gonna be favorable. So that's it for that problem. I'm gonna work one more. It has variable overhead again, but it also has fixed overhead, which we didn't do in this problem. All right, so 1649 is the next one I'm gonna work. It's on page 695 of your book. And this relates, if you're looking at your book, to what's on page 675 to 679. And this one, it's NSF Lube, is a fast-growing chain of oil change stores, and it gives us the following data for last year's service. So it tells us they performed 475,200 oil changes last year. It had budgeted for 432 oil changes, and it gives us standard variable labor and support costs per oil change. So they have 10 minutes at $24 an hour, so $4. Variable support staff and overhead, 7.5 minutes at $16 an hour, so that's $2, it tells us. And then our fixed overhead costs, their annual budget is $1,036,000. Fixed overhead is applied at the rate of $240 per oil change, and then it gives us our actual oil change cost listed. And then it asks us first to prepare a cost variance for each variable cost, which is, actually it gives you the total. It gives you the oil specialist and the variable overhead here. And then prepare a fixed overhead cost variance like the one in Exhibit 16.3. So once again, for the first part, the oil specialist, of course, is your labor. So actual cost, actual inputs at standard price. I should have left my header up here. And then we have flexible budget. So for the oil specialist, our actual cost, here we have to find the actual cost, our actual price times our actual quantity. So we have $26 an hour is what we paid them, it tells us in the information. and it said we had, to get our quantity, it said we had 475,200 changes averaging 12 minutes. So 12 minutes is 0.20 hours. So if you take the 475, convert it to, instead of 12 minutes, 0.20, you get the 95,040 hours. So that equals actual cost of $2,471,040. Our actual inputs, which we just calculated, the 95,040 times our standard price of 24 gives us 2,280,960. So once again, the difference between these two is our price variance, 190,080, unfavorable because the actual cost is higher. And you can see we paid $26 an hour. Our standard was 24, so it makes sense that our price, of course, would be unfavorable. Efficiency variance, $24 times what would be our standard time here is supposed to be, I think it says, yeah, 10 minutes at 24 should be what they spend on each oil change. So of course that's 1/6 of an hour. So if you take 1/6 times 475,200 to convert that into the number of hours, you get 79,200. So that's what they should use. That ends up being 1,900,000. So here our actual inputs at standard price are greater than our flexible budget. So we have 380,160 unfavorable. So you can see both of our variances for labor are unfavorable this time. Variable overhead, which is the next one, we have for our actual cost $15 times, which it tells us is the rate that it's applied at. Or it gives it to us, it tells us $15 an hour for our actual, and 0.14 labor hours times the 475,200. So it just works it all out here. And we end up with 997,920 for our actual cost. Our actual inputs at standard price. So our standard price for overhead is $16 an hour. And our actual inputs were 0.14 times the 475,200. Which gives us 1,064,448. So we have 66,528 favorable variance there because our actual was less than our actual inputs at standard price. So our price variance is favorable. Now once again, we're basing this on labor hours. Or maybe not, because it's a different number of hours. Yeah, we do base it on labor hours. So we know this one's unfavorable, so we can expect to see an unfavorable here. So our rate is $16 times 59,400, because we take a percentage of the labor hours. To get that 59,400, it's they estimate 0.125 times the 475,200. All right, and then that's going to give us 950,400. So you can see here, this is higher. So we are going to have a 114,048 unfavorable variance there. I know this is similar to what we did in the last problem, but this last part was the real reason I wanted to work this problem. It has the fixed overhead variance, which we didn't talk about in the last problem. So the fixed is totally different formula here than, although we still have a price variance. Move that up. But here we're going to look at actual budget and what was applied. So, and that's going to be based on your production, of course, how much of it you applied. So we do have our actual cost. We look at what was budgeted, so the difference between our actual and our budget is going to be our price variance. And then the difference between our budget and what we applied is going to be our production volume variance. So this portion is based on whether you spent more or less than what you budgeted, which remember doesn't change with production for fixed. This portion, the budgeted versus the applied, is based on if you produced more or less than you thought you would, because your applied is going to be more than your budget if you're going to apply more. If you produce more than you budgeted for, you're going to apply less if you produce less, and that's all related to your production volume. So it tells us our actual fixed overhead cost is $1.2 million. Our budget, it tells us, was $1,036,000. So we see we spent more than we budgeted for. So we take the difference there. We get a price variance of $164,000, unfavorable. Our production volume variance, we applied, it told us it was applied at a rate of 240 per oil change, okay? So we know we did 475,200 oil changes. Now remember, it told us they budgeted for 432. So we know they did more, which is actually going to make our production volume variance, we know, favorable. So they actually applied 1,140,480. And you can see this is less, our budget is less than they applied. So we're going to end up with 104,480 favorable here. We still have an overall, this one shows the overall, so I'll go ahead and show you that. We still have 59,520 unfavorable, which of course is the difference between our actual and our applied. And also if you net these two variances, the 164 minus the 104,480, that's going to give you the overall unfavorable. You can see our unfavorable is bigger than our favorable. So we have an overall 59,520 unfavorable variance there. So that's it for the Chapter 16 problems. Feel free to let me know if you have any questions.